Hello everyone, welcome to MES e-learning channel. We are continuing with the session on inflation. The last session is on measures to control inflation. Now what measures can be taken to control inflation? Generally monetary measures are followed or fiscal measures are followed. Monetary means money related, or the central bank of the country takes these measures. So in this monetary measures there can be quantitative measures and qualitative measures. Another one is fiscal measures. Fiscal measures are basically by the government. So government measures are related to taxes, government measures are related to expenditure. Expenditure will increase money, whereas taxes are going to reduce money. So taxes are increased and government expenditure is reduced to control inflation. Anytime monetary measures are better measures than fiscal measures. There can also be some supply side measures which can be taken. Why supply side measures? Because generally when we talk about inflation, we say if the demand is more than supply, there is inflation. So if by any chance this supply is increased, it will be equal to demand and the prices can be controlled. So sometimes supply side measures are also taken. But generally in the economy, either monetary measures or fiscal measures. In monetary measures, there is like bank rate is there, or CRR is there, cash reserve ratio, or even repo and reverse repo rates nowadays, they are used to control inflation. Monetary measures are definitely a better measure than fiscal measure. So in the recent past, in many of the countries, a term is used what is known as inflation targeting. This inflation targeting is done by the central banks of the country. Central bank is the authority to control money in any of the country, either to increase or to reduce money. This inflation targeting was first done in New Zealand in 1990, and after that many of the countries have been following it. In India it was followed between RBI and Government of India. Jointly they decided to have a monetary policy framework in 2015, and they decided to bring in this inflation targeting. This inflation targeting in India has been set at 4%. 4% means inflation should remain at 4%. A mild inflation, good for the economy, with a band of +2 or -2. This +2 or -2 means inflation can go up to 6%, or it can come down up to 2%. So these are the permissible or threshold limit given for inflation. Within this range, if it moves, it is acceptable, but beyond it, if it goes, the central bank is answerable that why it has happened and what measures the central bank is taking to correct it. And therefore, this has somewhere been a main way out how to control inflation. In India, inflation has been controlled recently because of this inflation targeting. I hope you have understood this entire sessions. Thank you so much.